Financial Mutual Fund's fixed income outlook. In this short video, we would take a look at how different global and domestic factors behaved during the months gone by. This would be followed by our view on the domestic debt markets, which could in turn impact the positioning of our schemes. US Treasury 10-year benchmark yield softened during the month, closing at 3.88%, about 45 basis points lower than the previous month. A tweak in the auction supply from coupon-based sovereign bonds to treasury bills, supported by a relatively more balanced commentary from the Fed, led to softening in the bond yields. During the month, Jerome Powell mentioned that the Fed is aware of the risk of hanging on too long and is focused on not making that mistake. He further mentioned that both mandates, that is maximum employment and price stability, are now in better balance. As per the economic projections of the Federal Reserve, the Fed funds rate is expected to fall by 80 basis points in the next year, from 5.4% in 2023 to 4.6% in 2024. However, as per the CME FedWatch tool, more than 80% of the participants are expecting at least 125 basis points of rate cut by the end of 2024. 10-year yield in Germany has also softened by about 43 basis points, primarily attributable to softer macroeconomic data points. 10-year Japan yields have also fallen during the month by 6 basis points, closed at 0.61% versus 0.67% last month. Bank of Japan, in its policy, maintained status quo as expected, retained an easing bias, kept the guidance of growth and inflation unchanged, and also stuck to the yield curve policy. Onshore, the 10-year GOI bond yield fell by 10 basis points during the month compared to 45 basis points movement seen in the US in this period. It is important to note that the domestic sovereign yields have shown limited movement versus the move in US Treasury yields, as robust domestic economic data has taken precedence. The 10-year GSEC traded in a band of 7.16% to 7.29% and closed at 7.18% in December 2023 as compared to 7.28% in November 2023. At the primary auctions, yields on 91-day T-bill and 364-day T-bill softened by 3 basis and 2 basis points respectively during the month. Yield of 182-day T-bill remained flat at 7.16%. Systemic liquidity was largely in deficit throughout the month. For the last 3 months, CPI inflation has stayed below the RBI's upper tolerance band of 6%. In November 2023, CPI inflation printed at 5.55%, higher than October 2023 reading of 4.87%, but lower than median estimate of 5.80% as per Bloomberg poll. Spike in headline CPI inflation was attributable to food price shocks, especially in vegetables, cereals, pulses, and spices. Food and beverages inflation increased from 6.29% in October 2023 to 8.02% in November 2023. CPI excluding food and beverage inflation stood at 3.47%, below 4% for the third consecutive month, lowest reading since December 2019. Core CPI inflation has also drifted lower and closer to the target of 4% in the past few months. Core CPI inflation in November 2023 stood at 4.11% as compared to 4.26% in October 2023. Expectations of rate cuts in the US resulted in the dollar index falling by about 2%. Great Britain pound, euro, and Japanese yen, component currencies of the dollar index, correspondingly appreciated during the month. INR traded in a thin band of rupees 83 to 83.25 per US dollar and closed at rupees 83.21 per US dollar, an appreciation of 0.2%. In a recent development, the International Monetary Fund or IMF reclassified India's exchange rate regime to stabilized arrangement from floating for December 2022 to October 2023, a move that is strongly opposed by India. Forex reserves increased by about 25 billion US dollars to 620 billion US dollars as on December 22, 2023 versus 595 billion dollars as on November 17, 2023. Foreign portfolio investors were net buyers in equity and debt segment with an inflow of 661 billion rupees and 183 billion rupees respectively. Liquidity conditions continue to remain tight during December 2023. Daily average borrowing through MSF window decreased to rupees 0.99 trillion from rupees 1.3 trillion in the previous month. However, average liquidity deficit increased to rupees 1,208 billion as compared to a deficit of rupees 647 billion in November 2023. Credit growth stood at 20.2% as on December 15, 2023 versus 20.6%, a marginal decline month on month. Deposit growth stood at 14% as on December 15, 2023 versus 13.5% in the previous month. Global yields have declined during the month on the back of rising expectations of rate cuts. As per recent economic data, however, softness in some economic data gets offset by some other hawkish data, a mixed bag. For instance, jobless claims rose to 218,000 for the week ended December 28, 2023, which is higher than expected. And job openings and labor turnover survey job openings for October was lower than expected. 8.733 million versus 9.4 million forecasted. However, the unemployment rate came in lower than expected, 3.7% for November 2023 versus 3.9% expected, and wage growth also was robust. The dilemma that the Fed faces is A, there is nearly equal risk of raising its benchmark rate too high, which could derail the economy, given there seems to have been a softening in the economy as per recent months' data. Consumers are under pressure and businesses are cautious. Or B, not keeping it high enough and long enough, which could allow inflation to persist or worsen. Despite recent softening of CPI, core inflation remains fairly high at 4%. The macro environment remains fluid and challenging. On one hand, the debt market in US is factoring in rate cuts to begin as early as March 2024, resulting in the recent rally in bond yields. However, there are risks that the bond yields may remain under pressure due to higher fiscal deficit, which may result in mismatch of demand-supply dynamics. Brent crude oil has traded in a narrow range between $73.24 per billion barrel to $82.83 per billion barrels during the month and closed the month at $77.04 per billion barrels. Factors balancing each other were tensions due to the Red Sea disruptions putting upward pressure on prices, offset by jump in a supply from US as crude output hit a new high of 13.3 million barrels a day, keeping a cap on prices. However, it remains susceptible to surprises on the upside in the event of further geopolitical conflicts. On the domestic front, reasons driving the bulls are falling US yields, weakening dollar index, range-bound Brent oil, and foreign inflows in anticipation of bond index inclusion from June 2024 onwards, which can result in higher demand. On the supply side, reasons for being cautious in India are that globally rates remain elevated even after recent softening in rates. Domestic inflation is susceptible to volatility due to food components, as cereals, pulses, and spices have seen an uptick in prices. Growth remains resilient and liquidity likely to remain tight in the near future. Also, rupee remains at elevated levels despite dollar weakening. Given the uncertainty mentioned above, our takeaway is the three hypotheses mentioned by RBI that the domestic GDP growth rate is resilient, domestic inflation is still far from the target of 4% on sustainable basis, and globally rates are likely to remain higher for longer. The business economic cycle in India, with growth looking resilient and inflation likely to remain higher than targeted, should continue to mean that in the visible future, rate cuts may not be necessary from the perspective of the domestic economic indicators. Further, if RBI continues to keep this systemic liquidity in a tightening mode to curtail inflation, bond yields may not have a runaway rally even if global bond yields continue to fall. At the same time, domestic bond yields may go up if globally rates head higher, pressurizing the currency, but they may get capped as the demand-supply dynamics, unlike in the US, are favorable in India due to inclusion in the global bond indices. We see a broader range-bound movement of yields in India, and most investors could continue to be broadly neutral in duration and could focus on carry trades going forward.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.